Hello and welcome. I'm Mike King, and this is an Air Cargo Unpacked interview, a Freight Buyers Club production. Each month, I sit down with Neil Wilson, editor of TAC Index, the leading global price reporting agency on air freight rates and the calculating agent for the Baltic Air Freight Indices, to look at where air cargo rates are moving and what is driving them. It's been quite a dramatic year, hasn't it? So I started by asking Neil what's been going on over the summer, particularly over the last month or so.
Hi, Mike. Great to be with you again. And yeah, it's been a up and down year, shall we say. It's been pretty exciting, obviously, since March, particularly with that big run up and then the fallback, as I think we noted last month, beginning to happen. Let's look at the BAI-OHR, which is our kind of global composite of outbound, which will show you that it's been going down now for 4 successive weeks as we talk now, getting into late July, though it's still up 17% year on year to July 20th. And that's despite what we've seen as a re-escalation of hostilities in the Persian Gulf, with the impact on traffic, with carriers like Cathay Cargo, for instance, suspending flights to the Gulf for a period, and a renewed surge in jet fuel prices, which I think we'll come on to later in a bit more detail. But one question, I suppose, is why the rise in jet fuel prices, which we have seen, has not been feeding through so quickly to air freight rates, which is something we did see in March. It really jumped quite quickly when the US and Israel first launched their attacks on Iran, and Iran responded. Now, there may be a delay in it being felt, or it may not happen at all, I suppose, if there's a ceasefire which is restored quickly. As of today, that doesn't look very, very likely. But
It doesn't look very likely at all, Neil.
no, indeed. We're also now in the summer season, which is a bit different, I suppose, where there's normally a lull in prices a little bit, because there's some extra belly hold capacity that comes on when the passenger traffic increases due to the summer holidays. That tends to obviously increase the demand for jet fuel, but it also increases the capacity for cargo, which helps to keep rates a bit lower, particularly on lanes like transatlantic, which has a lot of passenger traffic. And then the other thing, I think the bigger thing, I think we maybe come on to in more detail later, is the carriers say for now, jet fuel is not so much of an issue yet in terms of securing it, even if the prices are rising, as they were more prepared this time. I think many carriers were taken by surprise by what happened in March and they weren't ready, whereas now I think there's been a tendency, maybe you find it more anecdotally, but talking to people in the market, for carriers to have secured supplies and hedged forward a bit more and be prepared for further shocks like we're seeing now. So to look in slightly more detail at a couple of the bigger lanes, China, Europe and China, US, these are two of the biggest by volume. What we've seen with China, Europe is that the rates have been coming off, partly I think perhaps because there's been the end of that de minimis regime. There was a rush before the beginning of July. And there's also this summer lull going on. I think what's also happening perhaps is that there's been some drop-off in capacity on those lanes because of the annual maintenance and things like that being done, some of the cargo carriers. So China, Europe has maybe not come off as much as you might have expected, but it has. Whereas China, US, I think, the volumes are still very strong. And the rates have been coming off like elsewhere, but from a higher level. And you can see that by comparing the two charts.
We heard earlier, Neil, about these key vessels such as tech and AI driving demand. How's this playing out in some of those Asian markets that have been on fire most of this year?
That's a really good question. I think we've touched on this just very briefly in the calls in recent months for the podcast. But the AI theme we can see, I think, pretty visibly in our numbers on certain lanes where the volumes are very related to it. And so one particularly is, or two particularly, Seoul, South Korea to the US and Taiwan to the US. So first looking at Seoul, you can see that despite coming off a bit in recent weeks, it's still up about 100% year on year, which compares with that 17% global average. That's an awful lot more. It's very close to peak season levels for the last 2 years, even now. And that reflects, we think, at least in part, that massive semiconductor business related to the likes of Samsung and SK Hynix. When you look at Taiwan, US, it's a very similar picture. You can see, despite the drop in the latest week, it had been continuing to go up for quite a long time and remains comfortably above the last 2 peak season levels, reflecting again that booming semiconductor sales business by the likes of TSMC in the case of Taiwan. Okay, and then looking at our spot rates, so like those indices that reflect all business going through, some of which is contract, some of which is spot. The spot purely, which we've been segregating out using a panel approach. Without going into all the ones we do now, I can tell you that the Hong Kong outbound, the Shanghai outbound, and the South Korea outbound have been trending down still, like the overall indices over the last 3 or 4 weeks. But the one that's maybe bucking the trend is India. India, which had that dramatic rise at the beginning of March, with rates doubling or more into Europe out of India because of the disruption in the Gulf. That had been trending down gently, April, May, so from May, June into July, but it's showing signs of firming up now, which I think reflects the re-escalation of hostilities in the Gulf. So that was an early indicator last time of what was going to happen. So if the rest of the market follows, it'll probably start trending up as well with a delay.
You mentioned jet fuel before. Obviously, rising oil prices, renewed hostilities right across the Middle East. It's looking worse than it has done for quite a few months, actually. Jet fuel really for air cargo is the joker in the pack. It's impacting all of these markets in different ways. Where has the pricing gone?
So this is an interesting question because obviously we'd followed the big surge that there was when the Iran conflict started, and then the trending down that followed into June with the ceasefire deal, seeing the jet fuel prices drop quite sharply. What's happened since the tensions and then hostilities have increased again in the Gulf is that the jet fuel has reacted very sharply again. So there's been, while air freight rates have been continuing to go down, the IATA jet fuel price monitor, which reflects the Platts data on jet fuel, that's been going up again for 3 successive weeks into July 17th, including a gain of 17.6% in that latest week that they put numbers out for. And that leaves it up 65.9% year on year, obviously much more than the air freight rates. Now, the two things are not totally correlated. In the jet fuel is only perhaps about a third of the cost of running the business, because there's the equipment, the personnel, and so forth that you have to pay for as well. But that does increase the costs. As we said before, why has that not been feeding through yet into air freight rates? And I think there is this fact that you get more capacity into the summer, which might increase the demand for jet fuel, but you also get a lull in terms of the demand. It's the low season for demand. And then the other thing, which I think I did mention before, which is the key thing, is perhaps that this time the carriers have been prepared. They've been much more prepared for it. They've bought ahead. They've secured supplies. It's not going to help them indefinitely if the Strait of Hormuz is a problem and the Red Sea is a problem and the hostilities in the Middle East go on. Rates are not going to stay low indefinitely, but for the moment, we're not seeing them feed through.
And what's TAC Index been up to last few weeks, Neil?
Well, one thing we've been working on, which I think you've had a little sneak preview of, is the TAC Terminal, which has been designed a bit like what we call an Air Cargo Oracle. So we're using the data together with other inputs, like other sources on the characteristics of routes and what kind of things are moving on them and who the carriers are, to give you something like we'd like to call like a Bloomberg terminal, but for air cargo, which gives you lane by lane detail. So that's a very interesting development, which we're just trialing with certain people at the moment.
And I tell you what, if you're a young journalist out there and you're new to this industry, you want to try and ask for a bit of access, because I wish I had it when I started out. It makes it very, very easy to understand exactly what's going on in each lane. It basically does your research for you. Neil Wilson, thanks for joining me today on Air Cargo Unpacked.
Thank you, Mike.
That was Neil Wilson, editor of TAC Index. Many thanks to Neil for his time and analysis, and thanks as always to TAC Index and the Baltic Exchange for their continued support of Air Cargo Unpacked. For more from the Freight Buyers Club, please subscribe wherever you get your podcasts. Follow us on LinkedIn and YouTube, and please share all of this on your social networks. I'm Mike King. See you next time.